Uh, I'd like to welcome everybody to this session, Who's the Right Investors for Me? It's a session of the Berner Kantonalbank together with the Bernese Business Angel Club, Are Ventures. My name is Guicho Fredi. I'm partner at Koyo Capital and co-founder at Are Ventures. We also run a podcast called Burn Rate. If you're interested to learn more about anything, a bit of marketing is never bad. Today I have in co-moderation with me Eric Rufer. He's also co-founder of Are Ventures, and he runs an ICT business called Substring. And then we have two amazing panelists with us, Tobias and Julian. Tobias has launched a food tech startup called Yamo, developing baby food in 2017 was the founding?
2018, yeah.
2018, and raised multiple financing rounds, overall 12 million of capital. So has a lot of experience with choosing which investors. And then in the end, they had to stop the company last year. So there are probably a lot of very interesting insights that he can give us in choosing the right investor and what it means when things are maybe not turning in the way you want. Then we have Julian as the last panelist. Julian is the CEO and founder of Relay, a Bitcoin trading platform. He pitched his first round at Are Ventures. Nobody invested, so it's their bad luck in the end. And he now just raised last December a Series A with international investors, Ego Death Capital. He has business angels on board and quite a lot of other investors. So it's going to be an extremely interesting session with a lot of insights from experienced founders that we can share here. Eric will take the position of business angel a little bit, sort of like that we have sort of the vision of investors as well, so we can discuss what we perceive, how we invest. Eric as a business angel, me as a VC, and then hear sort of the feedback of is that what the founders are actually looking for as well. So maybe as a warm-up question, I took a couple of things already in advance. What kind of financing did you guys get? Maybe we'll start with you, Tobias.
So we started just the three founders. We put in all the money that we had to basically found the company. Then built it for 1.5 years from prototype stage to product stage, and then we did a first crowdfunding campaign. That was not because we thought it would work, because everybody told us we should do it. And then after like the 1,000 person told us we should do it, when we said, okay, let's do it. Then we did it, and it worked very well. So we pre-sold product. It was not an equity crowdfunding campaign, so we pre-sold product. And then with that, we could show that there's actually somebody paying for the product that we had. And then based on that, we raised the first angel round. Back then it was called seed round. Today, I think we call it pre-seed round or something, like size-wise. And then from there, we raised a Series A and then later Series B. And we raised from angels, from early venture capital funds, from early growth funds, from large family offices. So we had everything. We also had a debt in the end for working capital financing. So yeah, cool. Every instrument possible.
Very interesting. We'll go into details of that a little bit later. Julian.
We didn't have money to invest ourselves, so we had to skip the bootstrapping thing and directly raised from angels. And then also we did a crowdfunding, and then VCs, smaller ones, bigger ones, Swiss ones, international ones from UK, US, and Europe and Switzerland. And then family office one. And that's pretty much it. So also, like, next to from a really venture and equity perspective, we have also played the whole instrument. And then of course there are like public funding stuff that we also apply to, like grants, because we were early stage Bitcoin company. This was kind of a red flag for many others. So it was really important to find the investors, both on the angel side. Oh, by the way, angel syndicates as well we had. And then from the VC and family office side that really believed in Bitcoin and already understood Bitcoin, because everyone else, we even talked to strategic investors like banks or MasterCard, for example, or Visa, etc. All these big financial, traditional financial companies, they were not on the same line. So this never worked.
Okay, so we have now mentioned mainly sort of like the equity financing perspective there. I mean, if we look at fundraising, it's not just all dilutive funding. There are all you mentioned the grants, but also there are a lot of startup prizes. I know you won the CEF award for the most innovative food or Gewerbe company, right?
Yeah, like production and produce and Gewerbe, something like that. Yeah.
In 2022, and so it's actually very well renowned and extremely positive brand story that you were able to build up. Did you also go through sort of the traditional programs, the Devigier or any incubator program that you did, or did you skip that part, or?
I think we applied for some of them, but we were always declined.
So a lot of work and no benefit. We have also in the audience at least some people in the jury. So a lot of work from for upfront, and then maybe you get nothing.
Yeah, I mean also for the Swiss Economic Award we applied I think 3 times, and then we always made it one step further, and in the end we won it. But I don't think there is a big cash prize.
But did it have an effect on sort of like on how the business performed, or
it was
B2C product?
I think it was very helpful internally for the employees, because when a company when you get this public recognition, it means for people something, and for us it was a big motivator internally. Why are we doing this, and this acknowledgement from people outside of the company.
So maybe being persistent is worth it. In the end, you'll get to the goal.
And did you get the feedback from the market as well after you received the CEF award?
For example, we sold mainly in retail, but also online, and I don't think that mattered for any of our customers. Also, not our suppliers or anything. I think these people that are in different ecosystem and realm. Within, of course, the startup ecosystem, it meant something, but I cannot buy anything with that.
And also for, I think, maybe investors, VCs, they usually have like a map. You need to be on their radar, and these challenges or these awards basically get you visibility, get you into the media, fintech, finance, startup, media, etc. And the more they write about you, the more maybe you're on the radar of investors and also of like basically ordinary people out there. So as a brand building overall, we have also made, and exactly what you said, like people see it as appreciation that work in the company. That's very important. So definitely there is some merit to that. We also try to apply to everything, and then to be on like a list, like for example, top 100 startup lists is really something that makes some waves, and you can use then also on your website. It's like a trust badge. So I think also for not only for users, but also for investors, partners that you maybe work with now or later. That's a good thing.
Yeah, I think so. I mean, take the VC perspective here. I mean, these grants and anything that sort of gives you public recognition is a point in the right media that we look at, and then you see, there is a new startup. If it's very early stage, if you know them, it's another addition of a sigil of trust, let's say. And then you say, hey, okay, a couple of people have looked at it and they say there is something behind. Because if it's just another new brand name, you have no idea what's behind. Then you have to sort of like make sure you allocate your time as wisely as possible. And if you have somebody doing a pre-DD, so you have programs that you trust a bit more, and then when they're coming on top, then you certainly start picking them on the radar and actually getting in touch with the founders. So that's at least what VCs that are professionally organized do. They concretely go to targets and say, hey, we would like to learn more, and that's a lot more valuable than all the pitch decks that you get sent to, because most of it is not even in the thesis. Eric, as business angel, how do business angels invest, and what's sort of like their goal with the investment?
Well, goal-wise, it's obviously earning money at some point. So yeah, you have a financial interest, of course, when you invest in a startup in that stage. Usually, angels tend to invest in very early stage startups, so the ticket sizes are usually not that high compared to VCs, family offices, or so on. But they believe in the idea and in the startup from day one, so very early. So can encourage the startup to to go further and challenge them to find the right market and maybe the right niche in the beginning, and from that on scale it out into some different areas. So of course there's a financial interest in making some money, since it's private money. You are a bit more cautious when it comes to investments. So you don't have a need to invest. So there's no like a VC where you have a period of the fund, and then you really have the need to invest. As an angel, you can take your time and pick out the right deals. Of course, you don't want to miss something, but there's also you're not in a hurry somehow.
And expectation-wise, when you invest and decided to make the investment, how long is a holding period that you're willing to take dividends? Is it okay?
Yeah.
And what multiple do you want from an investment when you look at it at the beginning?
It depends very much on the case. So I'd say I'm pretty open when it comes to the earning strategy, let's say. So I'm not rushing into exit strategies per se. So it might also be a dividend strategy. But if you go for a dividend strategy, of course you have to have the aim to hold a major stake in the company, that the dividends are kind of substantial. Otherwise, if you just have 1%, 2%, it doesn't make sense, because you're diluted after a couple of periods. So as an angel in the beginning, you probably hold a couple of percent, maybe 5, maybe 10, whatever, and it gets diluted over the period of time. So if you go for this dividend case, which I'm open to generally speaking, then you need to have a major stake in that. From an exit perspective, the period can also vary. But up to from 5 years on, at least minimum 5 years usually. Often it's way more longer, like 8, 10 years or even longer. Depends on how much the startup is open to shift the course, So you start up with one idea, maybe it fit, maybe not. I don't know how often you have pivoted, probably multiple times, market-wise, product-wise, and that could happen. And if you still believe in that chance in the idea, then it also can be longer. Depend also on your pockets, of course. So because often in the refinancing rounds, you need to reinvest multiple times. But at least from multiple wise, it's 10x plus.
Okay. Yeah, so that's something very important. Who to go to fundraise? Is it the business angel? Relatively long holding period, in a sense. Capital that is not stressed. I take the perspective of a VC, and I take a very extreme perspective here, because it's quite important in Switzerland. I don't think everybody thinks the same when discussing about VC. A VC is a fund. It's a structured financial product that has a lifetime of usually 10 years plus a small extension period, and that's also why when raising from a VC, it's extremely important to already have some sort of a exit strategy that you know in 5 years we can exit, because the fund is maybe already in year 4, so you have 6 years left, and these are things that are very important for the founders to understand how the investors thinks behind, because if I can't exit the company before the exit doesn't come before the fund end lifetime, then I have to sell it in a secondary and I lose money, and so I can't pay back my investors, and so from my perspective, it's a failure, because I don't generate the returns that I promised, and in the end, I won't be able to raise the next fund, because it was an unsuccessful financial investment. Maybe we add a little bit also on the family offices, just 2 words on how they invest, and then we sort of like go into the direction on the expectations of how to work with them.
Maybe Dallas can also add on if I say something wrong, because speaking for all family offices might be a little bit different, or difficult. But usually, as far as I understand, family office and the co-investments we did with family office was usually that they tend to write bigger tickets, so they have deep pockets. They also invest very strategically. There's no need as a fund, you said, so they're a little bit more picky when it comes to investments. So rather 1 or 2 or 3 investments, but with bigger sizes and long holding period. Maybe sometimes even idealistic when it comes to the topics they invest. So they also tend to invest maybe in sustainability, circular economy, in topics where other normal investors tend to be a little bit more cautious, where family offices are open to invest in these kind of topics and also making bigger bets. And the good thing is you can always come to a family office because there's no need for them to make or they're not depending on any kind of VC period or whatever. So they usually can invest all the time whenever they want.
Now you hear sort of like these three groups, CVCs, will include maybe a little bit later as well. But if you hear that, does that shine through when you discuss with these investors, or how do you sort of like react when you hear what how Eric and I now describe sort of like the investors per se?
Yeah, I would definitely agree. There's these three that probably for most early stage, let's say from 0 to 5 years, startups look at. Mostly it's like as a founder, you directly want to go to VC money. Like VC seems the golden way to go, right? First VC, then IPO. Well, but actually a lot, a lot of entrepreneurs should probably think twice, depending on what case. Like you should really reflect, what am I building? What's my 5, 10, 20-year story with this company? And then often it turns out that maybe it's a dividend case, maybe it's an SME, maybe it's more a philanthropic thing, who knows? So then for all of these, for example, a VC would not be the right fit, right? But everyone reads the startup journal, the announcements of 100 million raised there, 10 million raised there by VCs. Wow, I want to be like that. Well, not necessarily, right? If you don't need VC money, you shouldn't probably do it because there's a lot of downsides and complications coming with it as well. Only raise VC money from VCs if you need it and when you need it. Maybe you could also do some bootstrapping for a few years and only then go to VC, because once you are on this track, there's no going back, and basically then it's just up or out. From there on. And so there's a lot of pressure coming with it. There's a lot of expectations, a lot of complications, a lot of risks. So you should definitely think twice. And then if you're on this track, you go all in. And maybe it also makes sense to first try to bootstrap, then start with angel investors, and then more with VCs and family offices. And if same with corporate VCs. Once you add these, there's also no coming back, because it changes how you can raise from VCs after you have engaged with the strategic corporate VC, for example. So I would definitely agree to what has been said. And as entrepreneurs, you really want to think twice from who you are raising and where are you in your journey, where do you want to go, and who's the right investor. VCs are definitely very different than angels, and again, very different from family offices.
And how did you perceive it, Tobias?
I think I would agree with everything that Julian just said, just not the last bit about the corporate VCs. Because I would say usually people would say don't raise from a corporate because afterwards you would not receive VC money anymore. We raised from corporate in Series A and we still raised VC afterwards. It's in my view, and also how we looked at it back then, was you cannot give the corporate any special terms that would prevent others from investing later on. If they are basically treated as like a traditional VC, then I don't see any issue in that. If of course they have like a pre-sales right or a pre-whatever right, and then it becomes extremely complicated, and then I would be fully with you. So yeah, it really depends, because most corporate VCs, they let's say like this, there are those that really do this strategically, where they want to actually build something to then take you over and put you into their own corporate, and the others, they just look at it as a financial investment. And that is very different, these two ways how they work.
Yeah, so the financial investor is clearly sort of on the side of a VC, and the strategic investor, for different reasons. But I mean, raising funds can be the right way to go to a CVC, maybe. So there are a lot of good exits also happening to ABB or to other corporates that in the end swallow up the technology. For the founder, it's still a good exit if you have a 15 million or 20 million exit after a couple of years. But for a VC, obviously, it would be a very bad case, because you want to have these outliers that go early stage 30, 40x, and so this is like the alignment of interest on investors panel that we actually had last year. Probably it's still on video on the homepage. Then you can go and check that out. But obviously, the next part sort of goes in. You mentioned a lot of complication, and sort of like how you go out fundraising and see, hey, I see a nice, pretty VC outfit. They've invested in a couple of cool companies. What's sort of like then after the investment? Sort of like you mentioned, complication. What kind of challenges did you face in post-investment?
It's very different from also angels and VCs. Angels tend to be uncomplicated, in my experience, limited experience, right? So they come in and they're happy to be part of it. They're trying to help. They sometimes would waste your time, probably. They want a lot of time. They want to give a lot of advice, where you're like, well, this is not very good advice, but thank you anyway, because they are not very close to it. A professional angel has like 20, 30 or more startups in their portfolio, so they of course cannot be very close to your industry. And then, but still, you can't say no if they want to have an hour call. Okay, you go there, and then you go out after an hour, and you have wasted it. But that's okay, right? Then this basically you need to manage the angel investors as well, because if you have, for example, at this point, I think I have 25. Angel investors. If I want to have a 1 hour call with each of them every month, it's not a good use of my time, right? So you need to also manage expectations with them. But then with VCs, it gets tougher, right? Because they really want to, they basically want to help write the shareholder agreement. They want to put in clauses and conditions there that you need to understand. So you need to have a very good lawyer already there to make sure the contracts are still founder friendly, and they don't have too much to say. They always want to be very hands-on and have decisions rights and cover their risks, etc. So you really already at contract stage, you need to be very careful as a founder. And then there, of course, there's reporting you need to do. There are some VCs that are very demanding and want to have a lot of reports. Again, goes into the time wasting. As a founder, you ideally want to use most of your time to build the company, not to report to the VCs and the angels, right? So there as well, managing expectations and making sure the reporting goes through efficiently. Then again, as well, meetings. A lot of different interests. Basically, then you need to manage if you have 5 to 10 VCs, or that would be a lot, but a few VCs and a lot of angel investors. Just the complications basically grow with the size of the group. Everyone has different interests you need to manage, and hopefully the good VCs, and that's why it's so important to pick the right ones and not just take the first that offers you a term sheet, but really pick the right VC that is a good fit to you also culturally, and you like collaborating, because it's like a marriage, right? For maybe a decade you'll be on the same journey together. So it's really important to find those who then maybe the good VCs, in my opinion, they give advice when you need it, but they let you also do your thing when they are hands-on if you need them, but hands-off when you don't need them, and they let you do your thing, and they still let you be in the driver's seat and make decisions. Of course, help wherever they can, and they do have invaluable experience and network that they can share, and you should make use of it. And get all the advice, and then make the decision what is important for me as my company, what can make the impact for us better, what can make us more successful. But then those who really want to be micromanaging and really close and to even operational meetings and decisions, and then for every 10K you spend, you need to go ask the board, etc. That would then stifle. I think the big risk is if you get VCs that are not very entrepreneurial or more financial driven and very hands-on and micromanaging, that they slow you down. And that's the last thing you want as an entrepreneur, that your startup progress is slowed down, right? And I think that's a big risk with many VCs.
Maybe let's sort of go on sort of the choosing the investor, Tobias. How did you do that? You had CVCs, you had VCs on board. There are 50 VCs in Switzerland, hundreds in Europe. How did you make sort of like the decision
In the end, it's about people. There is a brand name, there is a Sequoia, and it has a big brand shiny name, but they have, I don't know, 20 partners, and every partner is different. And I think what is important is that you find a person that really understands your business, that has value add, and that you personally, on a personal level, can work with, where you are also complementary to a certain degree. And the thing is that most people would always tell you, please take your time to finding your perfect VCs. In reality, most startups don't have that time. In reality, most startups they cannot choose between Sequoia or Andreessen or Lightspeed. They basically have to take what's there. That's reality. Now, still, with that being said, I think it's extremely important that you choose your partners wisely, because as Julian just mentioned, you're locked in with them for 10 years. At least. And something that, for example, that I always did, and that's also something that I always tell founders when I work with them, when you first talk to VCs, ask them where are they in their fund cycle. Do they just start investing, or are they already about to close the fund, or like at the end?
Period, yep.
Because the drivers of the VC will be very different. If you will be the 30th investment they do after an 8-year fund life, and the fund is just 10 years plus one, then you most likely will have a VC that will come to you a year later telling you should sell your company now. So it's going to be difficult. Second topic, also very important, is find out if they actually have money. There is a ton of VCs out there that pretend to have money, but they don't, because they talk to you because they're also fundraising and they need to fill their pipeline. So they need to show to their potential investors, so their limited partners, look, I'm talking to very exciting companies. And the third thing is also try to understand who their limited partners is. It's at some point I just started asking, so who are your limited partners? Who is invested in your fund, because it also gives you a sense of how will they work. For example, do they have a pension fund and a university endowment? Then you know it's super high professional. If they have Russian oligarchs and Chinese money, and I don't want to make this sound bad, but it's just very different. And there's a different dynamic come into play, and something that is out of your control. And the one thing that you don't want as an entrepreneur is that too many things that are outside of your control, because already your business is to a large degree outside of your control. You don't also want your money to be outside of your control. So those are like 3 things that I tell all the entrepreneurs that I work with are very, very important. And coming back to what Julian mentioned before, and that's, I think, the most important thing is, do you really want to go the VC track? Because it comes with certain obligations that might not be for you. Building a startup is hard enough, but being responsible for money that you get from people that expect you to not 10 exit but 100 exit, it's not for everybody, and it's okay if it's not for you. That's something I think many times it's seen as the shiny thing that everybody aspires to have VC money and so on, but maybe it's not you. And I tell all founders that I work with is just be very honest to yourself. Is this what you want to do for the next 12 years in your life with everything that you have? And can you take it to be accountable for the money that you get? I don't know how many of you have raised money and how much you have raised, but it's a different thing when all of a sudden you have like 7-figure sums of your bank account, and you know actually this should be 10 times that in 5 years.
Mm-hmm.
Yeah.
Yeah, and that's also again a big difference between angels and VCs that we haven't covered. Angels are investing their own money.
Yep.
That's why they are a bit more relaxed, because usually they have, let's say, a portfolio of, say, 10 or 20, probably more 20 angel investments, and that represents 10% of their whole net worth. So even if all of them go to zero, usually they're like, didn't work, but okay, 10%, I will make it back in the stock market or whatever. Yep. But for a VC, they have raised maybe 100 million, 200 million, 500 million from pension funds, institutional investors, family offices, high net worth individuals, etc. And they all expect a return back from them. So of course they are very nervous, right? Yep. And you can tell how you work with these people. They are not patient. They are they're under a lot of pressure, as you know, because they are managing money of other people, and then if they invest 10 million into a startup and then it doesn't go well, they will be knocking at your door. They will be with you every day. They want to have calls. They want to try to influence. They maybe want to force a sell or whatever. So it's very different.
Yeah, I think that's a very important point. I mean, that's absolutely correct. It's not that we VCs want something bad for the founders, but we need to push the business forward, that it actually makes 10x on the capital that is on the bank account. Maybe it needs another financing round, and there it's also important to engage the VC in these discussions early and leverage all these networks. And there you better have a VC that is supportive and not and doesn't turn off very early on. Yeah. And one thing that you said, Tobias, is very important in my opinion. Is don't be shy. Ask questions to VCs where you stand in the cycle. If they can't tell you, you're probably talking to the wrong level of the VC, because if they don't know when they at which point they are in their investment period, then it's probably an analyst, and you have a very long way anyway. And then try to force a meeting with a partner relatively early. Be bold. It also shows the ambition of the founder. So that's something which I always think is a positive thing if the founder wants to discuss with the decision takers and not just engage in a process where he maybe learns a lot about his business, but then hasn't influenced any kind of the decision.
And something I think that is very important, that VCs, they will do due diligence on you. They will have a ton of reference calls. They will really try to understand who are you, what are you building, and founders should also do these reference calls. And something I also at some point started doing. Talk to founders where that VC is invested in. Talk to founders where that VC did not invest in. I have a blacklist of funds. Whenever a founder comes to me and tells me, look, I want to raise from them, and tell them, don't do it. Just don't talk to them. It's a waste of time, and they will not be helpful. And that's something that for example, there's a community of founders throughout Europe, and where we all are together in one large Slack channel or workspace with 2,000 people, and it's always conversations about, I'm raising from X. Anybody has some prior experience with them, and then people will tell them, look, don't do it. They're shit. And this needs to happen, because in the end, VCs have for too long been able to just continue doing what they've been doing. And there are fantastic VCs, don't get me wrong, but there are also VCs that are not great, and they should be out of business. And because in the end, the money that you receive as an entrepreneur is super, super important. You can only build something with that capital, but you need partners on your side. Partners that know how to build the business together with you, and are with you in good and in bad times. And there are fantastic entrepreneurial investors that do this, but there are also tourists. That in 2021, when there was cash abundancy, they started investing in VC because it was a fun thing to do, and then in 2023 they were gone again, and you're stuck with them.
Yeah, absolutely.
That's kind of in
maybe let's add to go to Eric as a business angel in terms of business angel, smart capital. You mentioned, hey, they want to waste your time. Obviously, that goes against. Obviously, it was a stab in your heart, Eric, a little bit in terms of how we can
manage that.
What do you expect when you invest, and how do you actually support a company? I mean,
well, it depends on the phase of the startup. So as when VCs are coming in, usually the influence and the participation part decreases a lot, because the VC has a bit more influence, especially when it's our investors outside Switzerland. So we had once around with Dubai investors and United States and London, and it was very different when just a Swiss VC went in. So but when it's early stage, you can of course influence a lot or try to help a lot. So but as you said, it's can vary a lot, and it should be chosen very wisely. But the one thing is, of course, supporting them with opening doors. So of course, usually business angel has lots of network competence, so knows a lot of potential customers, suppliers, other missing capabilities that the startup currently don't have. Also supporting them with making business decisions, but more on a strategic level. Let's say usually the startups that I was working with, they tend to want to build everything in-house. So building a tech team, a production line, and blah 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 blah. Things that usually need a lot of money, a lot of time, and can fail a lot. So also focus in the beginning on being lean and outsource what can be outsourced, and don't make things too complicated, to really focus on what is really value adding in the beginning, and then afterwards you can, if the business is successful, then you can insource anyway all the time. So those things are things as an angel you can do. Of course, if you have a board seat, then you can of course influence a lot more, but it's usually dependent on the area or of the sector where a startup is working. So there are sectors where I know a lot more. So when it comes to AI stuff, then or predictive maintenance stuff, I usually tend to know a bit more than the average person, so I can support it maybe a little bit more. And if it's a little bit outside of that ecosystem, then I'm also happy to not participate in too much.
Yeah, so maybe on sort of like the founder side, on the founding partner side, you have the business angel. They have a bit more patient capital. The VCs can be very good. There is a blacklist. Ask Tobias to get on on that Slack channel. I would like to see that as well.
Me too. I was also interested in a blacklist.
But, I mean, it's a very strategic decision on how you build that path. And Julian, you mentioned before, you start with one round, then it's one after the other, and so it's a full cycle pathway. When you go through VC financing, it's not that you go and raise 500K and then you stop. You run 12 years with that outfit, and you add other capital along the way to make an exit, and that's not for every business, not for every founder. So it's a very conscious decision that I take out of this discussion. And maybe sort of like to move to the last 5 minutes. We're going to what we have done differently now, standing a couple of years into the businesses. Which were the sort of like the biggest learnings that you want to share with the audience here? And we'll start with you, Tobias.
I shared some of them before, very operational stuff. I think what is key is that you try to build your company in a way that you can juggle around with your money so that you can prolong your runway if you can't find a matching investor, because it's better to maybe slow down growth for a while, for a couple of months, but find the right partner for you instead of keep on running on with firing from all cylinders, but then having to work with somebody that kills your company afterwards. Because it happens all the time. And one of our very earliest investors once told me, Tobias, it's a jungle out there. And and if it's a jungle, then you can expect snakes and lions. And I don't want to be negative about it. It's just you need to be aware of it. And there's a ton of really great people also in that industry. Don't get me wrong. And they should receive all the merit or the acknowledgement that they deserve. But there's a lot of also rather,
dubious. Maybe it's the word you look.
Yeah, exactly.
Yeah. So think and do due diligence before you act. That's
one of my earliest investors always told me, think about, would you want to drink a beer with that person, and would you want to be in the trenches in the war with this person? It's kind of two things. And if you can't answer the question with a yes, then it's a no. And if it's a maybe, it's also a no.
Definitely.
Yeah.
Another one is, would you like to work for this person?
Yeah, that's a good point.
Would this be, if this would be your boss, would you be happy? If no, don't work with him.
Yeah.
Maybe to your sort of like retrospectively, only towards like when somebody financed you, which you said like, hey, shit, I wouldn't do that anymore. That was a completely wrong decision to move forward.
I think what we did wrong is we overspent, or we didn't spend efficiently enough. It's all about, in the early years of a startup, it's all about learning very efficiently with a limited amount of capital, learning as much as possible. So when you get to the next round and you get more capital, you can invest it more efficiently to drive the success and the milestones and the growth, etc. We, for example, have way overspent the last few years in marketing. That has brought us to a part where we are now, which is great. But we have underspent in product. And so we should have basically at the beginning, because the first time you mentioned the 7 figures, the first time you see 7 figures is like because before you were running on a 100K bank account, and then all of a sudden you have 2.5 million. You have 2.5 million on the bank account. You're like, wow, now basically limitless, right? There's no limits. So let's spend all of this money on growth and marketing. What you see is basically then the customer acquisition costs go up, the efficiency metrics all go down, the conversion rate is going down, the retention is going down, everything is going down, and then also the bank account is going down very quickly. Even if it's 2.5 million, can be a few months, and then you're back in fundraising mode, and it takes you half a year to 9 months again to raise the next round. And if you do this several times, this mistake, then you dilute yourself way too much as a founder, right? Every round, you should only really raise a round if you really need the money to get to the next milestone. Otherwise, because every time it's a huge time commitment, it's 6 to 9 months, sometimes 12 months, and it's 80% of your time as a founder that you could invest into the company, and it dilutes your own share in the company. So raising a lot, yes, but then really efficiently, you should really efficiently spend it. That's something we probably didn't do. We could have done better.
Maybe one add-on question that you had probably by then already a VC on board, and like, yeah, let's spend the capital because we believe in the growth. Otherwise, you wouldn't have done it. How did they react, and how important was it that you had a very good relationship to them?
Well, we had VCs that really think big. And so they're used to founders that are a bit overambitious in spending. And I think they probably know that, okay, they will learn to spend it more efficiently later on. But it is a kind of an inefficient process, right? I think these learnings need to be done. Also, it was a different time. We raised our 2.5 million seed in 21. And so then it was really about, spend the money as fast as you can, get more market share, and then raise more, because money was VC money was really available. Now it's a very different time. VCs are way more looking, on unit economics and profitability, etc. But yeah, our VCs actually are encouraging us to spend a lot to get a lot of growth. And they don't really go the 1, 2, 3 levels deeper on, okay, is this the most efficient way you could spend it? You want to spend 500,000 in marketing? Great, do it. But they assume that it's going to be efficient. As a founder, you need to ensure that every dollar you are spending brings you at least $1 or ideally $2 back.
So very, very interesting insights. For business angels, we don't need any add-on. We'll open the room for 2 questions, if any are in the room. No, we'll start back there, Mike. Sorry. Yeah, you get punished, Joe. We were too quick, too eager.
Thank you already for your answers and for the questions you guys asked. It was very interesting. Maybe for a question for you, Tobias. You said you also used CVC money. How was it different to working with regular VCs? And also, did you benefit in other ways than just receiving the money?
It was not different. It was the same, because in the end for them it was a financial investment and not a strategic investment where they want to incorporate us or anything. Of course, we had the idea then to do certain things together. We also did. So, for example, in R&D, in our case, we worked together with the corporate's R&D team to develop some new stuff, which was helpful. But it was also, I would say, from a pace very different than what we were used to at the startup. But it was for free. So, yeah.
Then we have the last question in front here.
Thank you very much for sharing your experience. I guess you had Swiss investors, Swiss VCs, but also one from America. Or what are the difference? Do you see any difference how they work with you? What are the difference between these two types of investors?
I think that goes to you.
In my experience, the US investors really want you to think big and bigger. That's what I have learned from the US investors. It's really like you want to go for the whole market. You don't want to go for 1% of the European market. You want to win this whole thing. It's really inspiring. On the other hand, they tend to really also be more hands-on, and really they put on more pressure, and they also often think they know better than you, while they spend maybe 5% of their time on your case, while you spend 120% on your case with your team of dozens of people. So you'd probably know most of the times better. The operational decisions or hiring decisions. You should hire people like that. You should hire bankers. I'm like, we're a Bitcoin startup. We should not hire bankers. Right? But these are often they kind of know better. So it's again, how do you manage this, and so that you keep your autonomy where you need it. But what I really appreciate is they really think big, and I think that's the role of a VC in the end as well. Help the founder to think bigger and achieve even bigger things. He's already on the right track, but how can we make this market bigger? How can we get a bigger share? And it's never enough, right? Oh, you reach 10 million ARR, great. How can we reach 100 million, right? This I appreciate a lot.
Yeah. Cool. Hey, thank you, Julian, Tobias, Eric, a lot for these insights that you shared with the audience, and thank you everybody for taking the time to listen to us, trying to give you some insights on who are the right investors for you, and please give a big hand to the three here. Und
this was fun.